Let me ask you a simple question. Why do investors get so excited about earnings seasons? Because profits drive returns, right? This is what we have all been told. But here's the problem. That relationship doesn't always work the way people think. And right now, it matters more than ever before. Because in this video, I'm going to show you something most investors completely miss. I am going to explain why strong earnings growth today can actually lead to weaker returns tomorrow, why markets often punish good news, and how this massive spending on AI by companies like Microsoft, Amazon, Meta, and Alphabet could drag down future profits. If you understand this, you will see the markets very differently going forward. Let's start with the big picture. We are in the middle of one of the strongest earnings periods in years. Companies like Alphabet, Microsoft are all reporting strong revenue growth. Amazon's cloud business continues to expand. Meta is generating enormous cash flows from advertising. On the surface, everything looks strong, and many investors are using that as a reason to stay fully invested, even when valuations look quite stretched. This might sound reasonable, but there is a flaw in that thinking, in my view. Because markets don't reward what has already happened, they price what comes next. Now let's break this down properly. Over the long run, earnings growth is the only key driver of returns. This is your anchor. Earnings compound, value compounds. But over shorter periods, returns are driven far more by two things: income and sentiment. Income is what investors receive along the way. It could be dividends and buybacks. Sentiment is what investors are willing to pay for those earnings. That is actually captured by the price to earnings ratio. And sentiment can move a lot. Optimism, fear, momentum, excitement, you name it. So in the short term, markets are not purely about fundamentals. They are about expectations. And expectations are often wrong. Here's the key insight. When earnings have just grown very quickly, future returns tend to be weaker, not stronger. This sounds counterintuitive, but the data is quite clear, particularly in the US. The strongest earnings growth usually happens during recoveries, after recessions, when expectations are low and valuations are reasonable. That is when markets perform well, which makes all sense. But outside of those periods, fast earnings growth can actually be a warning sign, because it often happens later in the cycle, when margins are already high and expectations are already elevated. We have seen this picture before. Before the crash in 1929, before the drawdown in the early 70s, before the dot-com bubble burst in 2000s, and again before the financial crisis in 2007. In each case, earnings growth looked quite strong, but the returns that followed were rather disappointing, sometimes significantly so. There is even long-term evidence showing an inverse relationship. The faster earnings have just grown, the lower the returns tend to be over the next year. So why does this happen? Because expectations get stretched. If investors expect strong growth, that expectation gets priced in rather quickly. So even if companies like Microsoft or Amazon deliver good results, it may not be enough. And if they fall even slightly short, markets react quickly. Now let's take this a step further. Because today there is an additional factor at play: artificial intelligence. The largest companies in the world are spending extraordinary amounts of money on AI. Microsoft is investing heavily in data centers. Amazon is doing the same through AWS. Meta has ramped up capital spending significantly. Alphabet continues to invest billions into AI infrastructure and cloud. In just one quarter, these companies collectively spent well over $100 billion on AI. For the full year, that number runs into hundreds of billions. This is not just incremental, this is a structural shift in my view. Now that spending is being framed as a growth story, and it is, but it is also a cost story. And this is where many investors are not paying enough attention, in my view. When companies invest in infrastructure, they do not expense it immediately. It goes on the balance sheet and then it gets depreciated over time. This means the impact on profits is delayed, but it isn't avoided, and we are already seeing it. Depreciation expenses are rising across these companies. Meta, in particular, is seeing a sharp increase as it builds out AI infrastructure. Amazon as well, given the scale of its logistics and cloud investments. Microsoft and Alphabet are not far behind either. And here's the key point: AI infrastructure has a relatively short lifespan, 5 to 6 years in many cases. So the spending we are seeing today will hit earnings for years to come. Think about what that means. Today's investment becomes tomorrow's expense, and that expense reduces reported profits. Now, to be fair, these companies can afford it. Their core businesses are still strong, right? Alphabet's cloud is growing rapidly. Microsoft's Azure continues to expand. Facebook is monetizing AI and advertising. Amazon remains dominant in e-commerce and cloud. But that doesn't remove the risk though, because markets are forward-looking. And if margins come under pressure, valuations can adjust rather quickly. We are already seeing signs of this. Meta's share price has reacted negatively at times when capital spending guidance increased. Tesla has been punished for rising investment plans. Even strong companies are not immune, because investors are asking a rather simple question: will these investments generate returns? If AI delivers strong returns, this spending would probably look justified. But if it doesn't, then depreciation becomes a persistent drag on profits. So now step back and look at the full picture. Strong recent earnings, high expectations, and rising future costs. This combination matters enormously because it challenges a very simple belief that strong earnings automatically lead to strong returns. They don't. Over the long run, earnings growth drives value. This remains true, but over the next year, returns are driven very much by income and sentiment. So the question is not whether earnings are strong. The question is what is already priced in by the market and what could disappoint. Because this is where the actual risk lies. Not in what everyone can already see, but in what the market may be getting wrong. If this video has helped you better understand the current investment landscape, please consider subscribing, and I'll see you in the next video. All the best.